Brad Hedrick here with Commercial Lending X to talk to you about some major changes to the SBA loan programs and how a deal that works today may no longer work tomorrow based on the new rules. Sorry for the quality of this video. This information is so timely and important, I could not wait to get it out to you. On Friday, August 14th, the Trump administration released their second set of major changes to the Small Business Administration's SBA Standard Operating Procedure, referred to as SOP, since taking office. Before diving into the specific changes, there are a few things I want to point out. First, the new SOP states in the footers throughout that the effective date is October 1st, 2026. However, the effective date on page 2 of the SOP document itself states to be determined. So we're not 100% certain if October 1st is the final effective date. Secondly, the SOP was pretty sloppily put together. We found several glaring errors in the SOP, a few places where changes and rules appear to contradict each other, and two appendices missing from the document. So we expect there's some cleanup to be made by the SOP going forward. Third, the SBA reorganized the location of many of the policies and guidelines in this version of the SOP. It appears this was done to maybe streamline some items that affect multiple loan categories. However, it does create some confusion in trying to review both documents side by side. And lastly, the SBA usually releases an explanation memo with a new SOP going over the changes in detail, which often helps to clarify some of the new rules. However, we did not get a memo release like that with this updated version of the SOP. So we did our best to try to clarify these items for you. I do expect the SBA will release additional clarifications over the next few weeks, but in the meantime, we need to assume that the current rules are going to stick. The largest set of rule changes in this version of the SBA SOP have to do with change of ownership transactions, which is what I will focus on in this video. Change of ownership is any time an individual is buying a portion of or the complete ownership of a business. The largest percentage of loans running through the SBA 7A loan program over the past several years have been by far change of ownership transactions. Because the SBA has seen a large increase in early default rates and general default rates against these transactions, they have significantly tightened the guidelines around change of ownership transactions. And in fact, they created a whole new addendum titled Change of Ownership to address these transactions. This is what I am going to cover now in the video here. The first change is that you can no longer use the SBA small loan program, which is loans of $350,000 and less, to finance business acquisitions. Now, this isn't a huge surprise. Most lenders weren't using this program to do that anyways. But going forward, it just means that you need to be sure your total loan request is $350,000 or more to finance a change of ownership with an SBA loan. Secondly, you can no longer borrow more than the value of a business, even if it includes seller notes on partial standby or with forgiveness. The total debt, including seller notes, cannot exceed the business valuation. The only way to get around this would be via the use of seller notes that are on full standby for the life of the SBA 7A loan, which the SBA views as quote unquote additional equity, or by providing additional cash equity above and beyond the purchase price. This is going to have a huge impact on businesses that have seen growing revenues and cash flow, as you're not going to be able to or be as likely to get a value on today's cash flow versus historical cash flow. So we're going to really have to see how this can impact business values going forward. It could prove to be a benefit for buyers, as sellers may not be able to get as much upfront cash on some of these businesses as they have in the past. The third difference is the transition period for sellers to stay in the business on a contract basis has been extended from 12 to 24 months. This is really big for businesses where you need some licensing control going beyond at least 12 months with a new owner. You can now rely on the seller for up to 24 months. The fourth major difference is that you can no longer get a 25-year amortization by combining real estate and business debt if the real estate was 51% or more of the purchase price. You can still do a blended amortization between the real estate and a business acquisition, but it will always be a blend between the two and not an automatic jump to 25 years. I think this is going to lead many more buyers to split the two apart, 10 years for the SBA business acquisition loan and 25 years separate loan for the real estate, or maybe a 504 loan for the real estate. Fifth, seller notes on business acquisitions will not be eligible for refinancing until they have 36 months of repayment. This excludes standby periods. So there's going to be no ability to step back in and refinance seller notes relatively quickly after they're put into place. Six, for initial acquisition, this means a buyer who's buying a business for the first time. The required 10% down payment can no longer be reduced or eliminated. So seller notes on full standby for the life of the SBA 7A loan can no longer count as part of the required 10% equity. This is going to require all buyers to have seasoned equity in advance coming into transactions. Seventh, at least 5% of the required down payment must come from the buying principals and guarantors. Investor equity and borrowed funds can't count as more than 5% of the equity. So again, that means 5% of the required down payment is going to need to be seasoned equity coming from the borrowers or guarantors. And by seasoned, we mean cash that they've shown in their bank accounts for at least 60 days. 8, minority equity investments can only be considered equity if they meet 3 important criteria. The first is the investor must have less than 20% equity and exert no ownership control over the business. Secondly, distributions to the investors outside of distributions for tax obligations are prohibited until the SBA 7A loan is paid off. And third, additional equity investments beyond the required equity may receive standard distributions subject to any debt service coverage requirements the lender puts in place. What this all means is that you can still have outside equity come into the transaction. That equity can't count for more than 5% of the required equity in the deal. But you can bring equity beyond 5% if you need to pay more to fill some sort of gap, or if you're deciding to bring more equity, and it can come from investors. Investors now get the ability to at least get distributions to cover taxes, which was not the case under the previous rules. So to a certain extent, part of this change is a positive. 9, the debt service coverage ratio must be satisfied using either the last fiscal year end or an average of the last 2 fiscal year end statements on either a historical or adjusted basis. And for initial acquisitions, owner buyouts, ESOP and cooperative financing, the minimum debt service coverage ratio has been raised from 1.15 times to 1.25 times. So the underwriting has tightened. Business expansions still qualify for a 1.15 time debt service coverage ratio. Number 10, any seller debt not in full repayment, such as interest only for an extended period of time, must now be included in the debt service calculation based on an amortization not to exceed 10 years. So even though you may have it interest only, to reduce the required payments on that seller debt, the SBA is going to force lenders to look at it based on an amortizing term. So that seller debt is going to impact your debt service coverage level at a higher amount. 11. On any business acquisition where the business purchase price, excluding real estate, is $3 million or greater, the SBA lender will be required to order a quality of earnings report, with the only exception being owner buyout loans and ESOP and cooperative transactions. In addition, the lender must use the earnings from the Q of E to meet the debt service coverage requirements on the loan. This reliance on Q of E's is likely going to create a lot of confusion up front because now the lender must order the Q of E, which means the buyer needs to be sure the Q of E is providing them everything they need as well. Also, there's probably going to be concerns on timing of when the Q of E will be ordered. Can a lender approve a loan contingent on a Q of E, or are they going to require that Q of E before they underwrite a loan? There's going to be a lot of nuances here that are going to need to be worked out in the coming weeks. Number 12, the SBA is requiring lenders to meet the tax transcript requirements for change of ownership. So tax transcripts will be required in all cases. This is taking away some of the flexibility that existed under the previous SOP. Number 13, for business expansions and owner buyouts, the lender may reduce or eliminate the 10% equity requirement if they have determined that the borrower has sufficient liquidity and working capital to sustain operations following the transaction. However, the business must have a positive net worth at the most recent fiscal year end to qualify. And also, you cannot have additional working capital built into the SBA 7A loan. Now, you can still qualify for a separate line of credit, but you can't have working capital built into the loan and still qualify for zero down on these transactions. 14, you can now add additional guarantors with a business expansion. Previously, the ownership had to stay the exact same for a business expansion to qualify for less money down. Not the case anymore. You can have additional investors now come in. For an owner buyout transaction where you are buying out the other owners, you can now bring in outside investors, but the outside investors cannot own more than 49% of the business and would still be required to sign a full personal guarantee on the loan, whether they take a 1% or 49% ownership interest. Number 16, real estate associated with a change of ownership must have been owned by the seller for at least 36 months prior to sale. This is a completely new rule. So if you're buying the real estate, the seller would have had to own it for a while. And if not, then you're probably going to have to enter into some sort of lease or lease with option going forward. And finally, number 17, cash that comes from a personal loan to a guarantor where repayment can be demonstrated to come from a source other than the cash flow of the business, including any salary paid to the owner from that business, can count as equity. But this cannot count as more than 5% of the required 10% equity in a business acquisition. This is an important change because it is allowing greater use of borrowed funds. The challenge here, though, is you're going to have outside income to support those borrowed funds. Most likely, this is going to come in the form of a spousal guarantee if a spouse has the income to support that debt. Although most of these changes are somewhat negative in nature, all this means is that there's a new reality we all need to learn to adapt to. I think in the long run, those acquiring businesses could benefit from some of these changes, as it will be much harder to over leverage businesses going forward. For business acquirers, it is going to be more important than ever that you properly analyze opportunities and be sure that the cash flow will work on a historical basis and that the value will be there in the business you are looking to acquire. We will continue to provide our complimentary analysis of potential acquisitions to help verify the cash flow and potential value and to be sure these transactions are appropriately structured going forward. At this time, we have to assume the new changes will go into effect on October 1st, 2026. Because of that, if you have a loan in process that requires the existing SBA SOP to work, you need to get your loan approved and authorization pulled by September 30th, 2026. The loan does not need to close by September 30th, but you need to have your authorization pulled, and then it can close past September 30th or past October 1st. Most lenders will probably stop working on new requests under the existing SOP within the next few weeks, as they will not want to be overloaded in underwriting or closing trying to get deals processed before the end of September. So if you have a request you have not submitted for underwriting yet under these rules, you will want to get it submitted ASAP. As always, if there is anything we can do to assist you for any of your loan needs, please do not hesitate to reach out to us at any time at 630-988-4852 or via email at brad@commerciallendingx.com. We are prepared to do the heavy lifting the next few weeks to help all of our clients get through these changes. Thank you for listening today. We'll be back to you with any other updates that may come out. Have a great day.